Welcome back to Resonanz Spotlight, Strategy Notes. I'm Saad.
And I'm Vincent.
Today, we're talking about Quant, specifically how to do diligence on Quant hedge funds. And the starting point, which sounds simple but most people skip, is this: Quant is not a strategy.
It's a production method. And if you don't classify what type of quant you're looking at before you start underwriting, you're going to ask the wrong question, measure the wrong things, and be surprised at the wrong moment.
Which is usually a drawdown.
So let's fix that today.
Vincent, let's start here. Why does it matter so much to classify the strategy first? Can't you just apply the same framework across all quant funds?
No. And this is actually the core mistake we see with allocators. They ask the same questions to every quant manager. Sharp ratio, max drawdown, correlation to equities. And then they act surprised when the market neutral startup fund blows up from a short squeeze, or when their alternative risk premium sleeve drops 30% in a month of credit stress.
Because those funds failed for completely different reasons.
Exactly. A trend following fund fails from chop and whipsaw, from a market that moves sideways and triggers the exits over and over. A startup fund fails from crowding, from everyone having the same short book and liquidity disappearing the moment you need it. An alternative risk premium portfolio changed quietly, slowly, and then very fast because it was a short volatility trade disguised as a diversifier.
So the failure modes are specific to the strategy type.
Yes. And if you don't know the failure mode before you invest, you can't build a proper exit framework. You end up redeeming after the damage is done. And worse, you redeem for the wrong reason. Drawdown alone is not a reason. Drawdown with broken process, exposure drift, or liquidity mismatch, that's a reason.
Actually, put together 5 buckets. Let's go through them. And I want to make this very practical. The thing to look for, the thing to avoid for each one.
Okay, bucket one, equity statistical arbitrage. This is the high turnover, high breadth, long short equity book. The idea is market neutrality, capturing micro inefficiency, mean reversion, cross sectional signals. The edge is often as much about execution quality and research speed as it is about any single factor.
And the classic failure mode here is crowding plus short squeeze.
Right. When many funds share the same short book, you get a crowded trade. And when that trade goes against you, when the stocks peak short and suddenly rally, liquidity disappears at exactly the moment you need it. The whole market is trying to cover the same shorts at the same time.
The question to ask is, show me factor attribution monthly, not a summary, because market neutral is a claim. Factor attribution is the reality. You might find value tilts, momentum tilts, sector skew, things that look fine in normal times and blow up together in stress.
And you also want to ask specifically about the thought book, how concentrated it is, what is a borrow model, what are the limits if there is a sudden squeeze, because the thought book is where the risk actually lives in these strategies.
The red flag is where the manager says, our machine learning model finds nonlinear patterns, but they cannot show you data lineage. They can't explain when the data was actually available for the decision. That is leakage risk. The backtests look great. The live track record is much worse.
Bucket 2, trend following. Very different animal. Time series momentum in liquid futures, rate, FX, equities, commodities. The pitch is crisis convexity. The fund should go up when things go badly.
The failure mode is that it does not, because trend works in trendy markets and fails badly in range bound, choppy markets. That is not a bug, it is a feature. But allocators buy it expecting steady returns and are shocked when it goes sideways for 18 months.
And there is a hidden risk here that many people don't think about. Most trend programs use volatility targeting. They scale their position to hit a target volatility, which means when markets become volatile, they sell. And when markets calm down, they buy back.
They buy back in.
I repeat, and when markets calm down, they buy back in.
Which is pro-cyclical. In a stress event, you have every trend program selling liquid futures at the same time to hit their vol targets. That amplifies the move.
So when you're looking at a trend manager, you need to understand the leverage, not just the average, but the range, and what it looks like after a gap event in race or S. And you need to understand the execution model. Are they trading at close? VWAP? How do they monitor slippage?
And the red flag is crisis alpha claims with cherry-picked windows. Show me 2020, 2023, the 2015 China shock. Show me multiple regimes, not the 3 months where trend works perfectly.
Bucket 3, macro systematic. This is rule-based macro. Carry, value, momentum, policy signals, regime classifiers. The key difference from pure trend is more complexity, more inputs, more tilt, sometimes discretionary overrides.
And complexity is where it gets dangerous. More degrees of freedom in the model means more ways to fit the backtest. You can have a beautiful historical chart that simply does not survive on a sample.
The question I always ask is how many versions of this model existed before the current one? What changed and why? Because if the answer is we improve it without a clear logical explanation, what you're often hearing is we backtested our way to better number.
And when these portfolios converge, because macro systematic funds often converge, you get a correlation spike. Long duration, long dollar, short emerging markets, low quality equity. In a risk off event, all of those moves against you and at the same time.
So scenario analysis here is not optional. Ask for scenario P&L under inflation shock, rate shock, USD squeeze, commodity spike, equity crash. Not theoretical. Show me how the model would have behaved.
And avoid any manager who says, we predict macro. That is almost always wrong. What good macro systematic is doing is harvesting risk premia and managing positioning dynamically, not forecasting GDP.
Bracket 4. Alternative risk premium or ARP. This is a systematic harvesting of compensated factors. Carry, value, term premium, volatility risk premium, merger spreads, often delivered in an index-like format with lower fees than traditional hedge funds.
The problem is packaging. An ARP product can quietly become a short volatility trade or a liquidity premium trade with a nasty left tail. It looks like a diversifier in the presentation, and then in a month of credit stress and rising volatility, both happening at the same time, it drops hard.
The practical stress proxy I use for ARP heavy portfolio is to watch high yield credit spreads and equity implied vol together. If both are widening and the alternative risk premium portfolio is not protected against that, you have a hidden short position somewhere.
And the other issue here is fees. If you are paying hedge fund fees for factor exposure that is essentially replicable in a systematic index, that is structural pricing error. The premia are real, but you should price them like premia, not like bespoke alpha.
And this is maybe the most complex multi asset systematic, sometimes called multi strat quant, a portfolio of systematic sleeves across asset classes and horizons with capital allocation happening at the top level.
The diversification story sounds great. Trend here, startup there, macro over here, different horizons, different assets. In normal times, the correlation is low. And then in a real stress event, the correlation goes to one.
Which is almost always what happens. The question is how they allocate risk across sleeve. Is it role based, discretionary? How often do they de risk? And what triggers the de risking? Because sometimes the risk management itself is the performance driver. If you cannot evaluate that process, you are underwriting a black box.
Ask for its contribution by seed, not notional, and ask about liquidity mapping, the redemption profile for investors versus the actual liquidity of the underlying positions. Those two numbers should match. When they don't, you have a problem. Okay, let's zoom out. Across all five categories, what are the questions that always matter?
Three things: research process, liquidity, and governance. On research process, ask every manager to answer this in writing. How many hypotheses did you test to get to the current model? What is your process for data leakage control? What is the policy for model change? And who approves them?
Because if the model changes without documentation, you don't know what you own anymore. And if leakage controls are weak, the track record is not real.
On liquidity, this is not can I sell the fund, it is can the manager de-risk without moving the market during stress within the speed implied by my own redemption terms. Those two things need to match. European regulators have been pushing on this explicitly. The leverage and liquidity mismatch in alternative funds is a systemic concern, not just an investor concern.
And governance. Decide before you invest what would make you reduce or redeem. Write it down, not drawdown by itself. Drawdown happens. It is drawdown combined with exposure drift or broken execution or a process change that was not controlled. Pre-commit to that framework. Because if you decide it during the drawdown, emotions are already involved.
So let me try to summarize this in one paragraph. The allocator mistake is still the same one as always. Buying Quant as a label instead of underwriting a specific strategy type with a specific failure mode.
Classify first, then pressure test the specific exposures, not the marketing deck. Map liquidity to your investor terms, force transparency on leverage and risk throttles, treat crowding as a variable that changes return distributions, not just volatility risk, but tail risk, and price what you are actually buying. If it is premia, pay premia fees.
And do your exit framework before you invest, not after.
That is what separates a robust systematic allocation from a regretful one.
And that's it for today's episode of Resonanz Spotlight Strategy Notes.
If this was useful, share it with someone allocating to quant strategies. And if you have a question or a framework you want us to stress test in future episodes, reach out.
We'll be back soon. Short, sharp, actionable. That's the format. See you next.
Thanks for listening.